Righty, good morning, everyone. I can see a few people here already, which is great. Just before I introduce our guest for this morning and get stuck into the webinar, I do want to sort of announce a couple of things that we're doing coming up. The first one is we're in a bit of a regular habit of webinars, and we've got one coming up on the 4th of June, which is numbers for non-accountants. So we often hear from clients that they're not numbers people, or numbers isn't their strength, and that's totally fine. You don't have to be an accountant, but what we're looking to teach you is just enough so that you're able to make informed decisions in your business and understand what numbers you might need to know to grow your business as well. So Rose is going to pop the link to that webinar in the chat box now if you're not already registered, and we'd love to see you there. And just another thing, a bit of an update on our Save Tax campaign this financial year. So a couple of months ago, we sat down as a team and thought, what's a good target we can aim for to save our clients in tax for this tax planning season? And we're kind of just over halfway so far. And the goal we set was $2.1 million of tax savings, which, that's our biggest target yet for a tax planning season. And pretty cool. We got an update this morning. So far, we've reached almost $1.5 million, and we've still got quite a few meetings with clients to go to work out what that is, what their tax savings is. So I reckon we've still got about a third of clients that haven't added to that. So we're pumped. We're feeling confident in actually hitting that number. And the cool thing, and thanks to B1G1, and I'll mention B1G1 as well in a bit, but B1G1, for every dollar of tax we save our clients, we give a day's worth of food, water, health, sanitation, and the one that's not on there yet is education. So we've been actually giving a lot to a project in India that helps kids with e-learning, access to e-learning, which is pretty cool. So yeah, we've got almost 1.5 million giving impacts through B1G1 just as a result of the tax planning campaign. So that's exciting. I said I mentioned B1G1 again because our guest today, Joanna Oakey, I actually met her in Singapore randomly at a B1G1 conference. So I think we connected a few weeks beforehand. Actually, I think you interviewed me on a podcast that you were hosting, but we actually caught up in Singapore for the first time face to face, and that was a good conference.
Wasn't it fabulous? I just love the B1G1 community, and how awesome is this? I just love your campaign, and this is just it's just beautiful. But doesn't it give so much more depth to business? I feel like it does. But and then you meet fabulous people. What can I say? It's a win-win-win.
That's it. That's it. Well, welcome this morning, Joanna, and really awesome to have you on a webinar, and particularly about quite a complex topic that some of our clients ask us for sort of guidance on. So thank you so much for joining.
Oh, Ben, thanks for having me. I'm excited. I'm pumped. I love this topic. I'm so excited to talk about it.
Yeah, fantastic. And just as a bit of an introduction to Joanna, Joanna is the Managing Director of Aspect Legal, which is based in Sydney. Are you in the CBD, Joanna? Or?
Well, yeah, we're actually in the Northern Beaches. Well, I'm in the Northern Beaches. We have an office in the city, but I have to be honest, I haven't been there for ages and ages. I can't get past the city. We're also in Melbourne as well, but I like to try and hang out in the beaches.
Fantastic. And you work with clients all around Australia?
All around Australia, yeah, absolutely.
Mm-hmm. Awesome. And so Joanna and her team specialize in helping growing businesses acquire, consolidate for growth by building a fortress around their assets and eventually exit in a way that draws the optimal value they deserve out of their business. Joanna has worked with hundreds of high growth businesses during her 2 decades in the industry as they are growing, acquiring and exiting. And the way I met Joanna was actually through one of her podcasts, but she's the host of not one, but 2 top commercial law podcasts in Australia. First one is Talking Law, which provides smart legal tips for businesses. And the second one is The Deal Room, Australia's top legal podcast on SME mergers and acquisitions. So yeah, pretty excited to have you here. And just as a bit of an agenda or things we're going to run through, we're actually going to sort of split this webinar up, because I think when you're looking at acquisitions, I think it's important, and we both had a chat before, and it's important to have your accounting and your legal and yourself all on the same page as a business owner. So and there's aspects of both which are very helpful to make sure you've got covered. So Joanna's going to run through the differences in acquiring, or even like the philosophy of acquiring a business versus starting up, the key elements of the acquisition process, and essential steps in driving a successful acquisition. And then I'm going to cover a couple of numbery things. So the first one is just sort of broad topics or context of the value of a business, and things you might want to consider if you're looking to buy, due diligence, and then also 2 different ways to buy, which is a bit accountanty, but anyway, we'll get there. So what I might do, given Joanna's going to run us through first, is I'm going to stop sharing my screen. But before I do that, I'm going to launch a bit of a poll, which should show up on your screen right now. So the question is, are you considering an acquisition? So while I hand over to Joanna, if you could actually answer that one. So the options are, yes, I'm looking now, yes, in the next 1 to 2 years, 3 to 5 years, possibly one day, no, not at all, or I've never thought about it before. So while Joanna shares a screen, pop the answers in. Yeah, we'll go from there. All righty.
There we go. Have you got my screen?
Yes, we can see that.
And how are we going? I can't see the poll results there. How are we looking?
All righty. We are about 3/4 of people have voted. Thank you.
Brilliant. And if you haven't voted, please just throw your vote in. I'm super interested. It really helps for me to understand, where you're sitting in terms of what sort of part of the journey you are in that thought process, or not at all. No, you hate it. I'll talk to you about why you should reconsider your thoughts if you're a no.
Well, I might end it there, but the exciting thing is that no one is not considering an acquisition.
Oh, how about that? Okay. I love it.
There you go. Hang on, share results. Okay, now you should be able to see that on your screen. Everyone,
including.
Cool.
Looking now, okay, yep. In the next 1 to 2 years, and then possibly one day is 30%. Wow, so we've got the highest number are in looking now, and then yes, and then possibly one day. So that's great. Okay, all right. So what I would love is if you could add questions that you have as we go. And I haven't worked out how to bring my chat thing up on the screen. So maybe, Ben, you just tell me any questions as they pop in if you think it's relevant to what we're talking about. Otherwise, I have a Q&A slide at the end, because you have all sent in questions as you registered, which is awesome, because then I can meet you where you are, answer the questions that you have. In good news, most of the questions that you've asked are actually things that we're going to talk about anyway, so boom. But if we haven't, I've actually got a slide to cover off some of the things to make sure, we've covered it in the detail that you wanted. But I guess just kicking off, of course, today we're talking about acquiring a business, and I call it the secret source of growth, because I feel that it's such a massive opportunity that is missed by many SMEs. So our larger businesses use acquisition as a growth strategy, as a really integral part of their growth strategy. And almost all large organizations will have used it and probably be currently using it as part of their strategies. SMEs, it's a topic that isn't necessarily covered very often, and that many SMEs just don't know much about. So just going back, obviously, my name's Joanna Oakey. I'm the Managing Director of Aspect Legal, and we specialise in assisting businesses both acquire and also exit, because part of the important thing with acquisition is also making sure you're acquiring with an eye to what does this look like on exit as well. And we also help business businesses consolidate, and I call it fortify. So fortify their assets, build that fortress of protection around your assets as you're growing the business, because growth is the most vulnerable time for a business, believe it or not. And all of the great work that you can do through acquisition can be completely undone if you've got fires in your business that are attacking your assets. So that's sort of the trilogy. I see it, that acquire, consolidate, or protect, and then exit, as all working in an integrated way together to make sure you're really building something of value for the end of the day. And I am super, super passionate about this topic because I have worked with clients for decades in the area of law, and I've covered lots of different areas of law. And the one area where I feel that we can make the most difference is understanding what business looks like at exit, and how to get that highest value when you're at that point of exit, or indeed how to build a machine for yourself that maybe you don't even want to exit, that is so amazing to run that you can just hang in there for ages, but without, being locked into your business. I guess that's the thing. So as you have heard, I do have a couple of podcasts. Here they are, the Deal Room podcast, and we talk all about buying and selling businesses. So if you're not on that and you're thinking about an acquisition at any point, which apparently all of you are, you should be listening to the Deal Room podcast. Just type the Deal Room podcast or Joanna Oakey into iTunes or Apple Podcasts, I think they're now called, Spotify, wherever you listen to your podcasts. And then the other one is Talking Law, where we provide smart tips for businesses from a legal perspective. All right, but getting into today, obviously today we're talking about why acquire a business, the acquisition process itself, how to drive a successful deal, and what to do now. And then I'm going to cover off some Q&A, but I don't want to take too much time, Ben. So we're going to have to make sure I could talk about this area for hours and hours and hours. And I ultimately do on the Deal Room. So, so chime in anytime, Ben, if you've got questions as well, if you want to share anything, or if our listeners are sharing anything, and I'll try and be quick.
All good. No. Go for it.
Okay. All right. Fabulous. So obviously, let's start with why acquire a business. And we've talked a little bit about the whys. So we've talked about, this is a strategy that large businesses just get and they build into their business process. But SMEs, particularly in Australia, I think in the US, my study of international jurisdiction shows that actually many other countries are well ahead of Australian SMEs in terms of the take up and the understanding of the benefits of acquisitions. Here in Australia, we're a little bit more conservative, or is it laid back? Don't know, whatever. But we're SMEs have been a little bit less inclined to jump on the acquisition bandwagon. But, I have conversations day in and day out with business owners who have discovered this opportunity of acquisition. And I tell you, I'll tell you one story. So I was working with a client and I was having this discussion with him, as I often do, about what his business had looked like before he'd started on this acquisition path. And he said to me this: he'd spent 10 years building his business, as and putting blood, sweat and tears into it. We all know how hard it is to grow a business. And then at that 10-year mark, he had this opportunity to acquire another business. So he and his other business partners acquired this other business. And he said after that acquisition, he sat back and he realized in one single transaction, one single signature, he had added as much value to his business that he had done in what had taken him 10 years before.
Jeez.
And that's a big thing, isn't it?
Yeah.
And he then, once he realized the power, he then went on to say, hold on, where else could I use this to add value in the business? And then he got really strategic, because quite often it's not the first acquisition itself where the main power is as well. It's about when you're taking this knowledge, you're taking the knowledge and you're then adding strategy to it, that you really work out how you can make the most out of acquisition as a growth strategy. Now, I'll tell you another story, because this story came from just last week. So we had, so I want to give you, like a right to the minute, information here. But we obviously, as I've said, we do lots and lots of work in acquisitions, but also in exit. Which is super useful because we know where value is at exit. And the business owner that I was speaking to, we spoke a lot about the opportunities, and we'd had this discussion over a few months in terms of prep for exit, right? And I just said a couple of things about acquisition, and he'd been thinking about it anyway. And then he came back to me. So this was last week, and he said, do you know what? I've decided to put on hold exit for another 6 months, because I just decided I'd been looking at this business that was really simple for him to acquire. And I've suddenly realized I'm selling for a 4 times multiple at the moment on the basis of and when we talk about multiple, I'll talk about that soon, but we're talking about the way to value business, which I think you'll talk about, Ben, right? But one of the ways to, linked to the way to value business is always some sort of calculation. So that might be profit or EBITDA. We'll talk about that later on, multiplied by a number. And that number that we're multiplying it by, we call the multiple. Makes sense, right? So we've got, but the point is, it's not just the profit that drives value, it's the multiplier that you add to the profit, right?
It's the game changer, really.
Right. Yeah, exactly. And sorry, Ben, I'm using profit in a really crude terms here, I'm sure.
All good. No.
but it's just to demonstrate this point about the opportunity of adding value by looking at your multiplier. And so what this guy did, who's got a really good business, and he's looking at a multiplier for around about 4, maybe 5, so 4 to 5. He realized that he could buy this business for a multiple of 1. And he knew, he calculated it straight away. I buy it for a multiple of 1. I roll it in. When I sell it, I'm now going to get an uplift in that acquisition from a multiple of 1 to a multiple of 4 or 5. How's that? That's
that's awesome.
Immediate uplift in value. But then I said, that's brilliant. I love it. And then he went, yeah, but hold on, maybe I should do more. So like then that's it. I'm just like, okay, well, don't take your eye off where the target is. You actually wanted to exit. But you know what I mean, Ben? I mean,
absolutely. And the sort of thing I've got in my mind about that is, when we were kids, we probably played snakes and ladders, and you're rolling the dice, you get 4. Oh yeah, you move your piece along 4 little things. Then you roll a 6. Oh, that's a good number. Yep. And you're slowly making your way there. If you land on a ladder, you like skip rows. A good one.
And you know what? What a great analogy. Yes.
So 100%. From a business growth perspective, I think that's a pretty cool way of thinking of it. And I guess they call it snakes and ladders, not just ladders. If you get the wrong one, you could probably go backwards a few steps too.
You know what? You're absolutely right. So you are potentially amping up your risk, which is exactly why I've got some of the things I'm talking about today. What a segue. Can I promise we did not coordinate this beforehand?
We didn't.
It's a true segue. Okay, so you can probably see why I get super excited about the whole idea of acquisition of businesses. And I think, look, I think, to be clear, I'm really an entrepreneur at heart. I used to hate with or just talking about risk, because I'm like, there's so much more that's important. Risk is super important to protect, but there's so much more as entrepreneurs that drives us in business. And that's why acquisition is such an exciting topic, because it really is, where in law, we can add that ladder. I love it, Ben. I'm taking that. That's okay. Yeah. So why acquire a business? The speed of growth, organic versus acquisition. And I think that's ultimately what we've been talking about here. The idea that in a single signature, you can double or triple or quadruple the value of your business in comparison to decades of building a business is, I think, the number one reason for SMEs to consider acquisition versus, and I say versus organic, but of course you never stop with the organic, but it's just looking at that as an alternative to just having your blinkers on and only looking at organic, which is where most SMEs are, right?
Yeah.
So this is about pulling off the blinkers. Number 2, add more clients, achieve economies of scale. And I guess what I'm actually saying there, and that's obvious, like, of course, you're buying a business, so you're adding revenue, but you're not just adding revenue. You have the opportunity for increasing profit in both the acquired entity and your entity, not just through economies of scale, which is what I'm talking about here, i.e. you're bigger, and so you can negotiate better buying, supply costs. But actually what number 2 should really say, good tip, I might change my slide, is it's about increasing profit because you can pull out expenses for duplicated items, so duplicated admin, duplicated marketing. There's just so much more that you can do when you're putting these parts together than what you can do with the one entity.
And I know this might sound really bad at maths, but in a way, 1 + 1 = 4, not 2.
Oh, do you know what? I'm so okay. I'm just changing all my slides to this, Ben. I'm adding ladders, and 1 + 1 = 4. I love it. I love it. Adding more services and products to sell to existing clients. Now from I guess the first starting point, you're actually providing a more fuller. But you have the opportunity to use acquisition to provide a more fuller service or solution to your clients. So that's the first thing. But then think about it. If you've got 2 separate client bases that have something that they're crossing over in, which is usually what's happening in a target that you're acquiring, you have the opportunity to cross-sell and upsell to each other. You've just suddenly got this, not only are you getting the benefit of the profits in the business that you're acquiring and the uplift, because now you've got a higher value and so therefore a higher multiple, and then rip out the profits, the expenses, so you've got a higher profit in both. You also now have this ability to cross-sell products and services to each of the other client bases if what you're acquiring is an extension to your current products and services. And I just love that element of acquisition.
And I'm even thinking, like, in what we do, so a lot of accountants just do the tax, and for the last few years we've been doing this sort of set of services called Wealth for Life, and soon also Total Financial Control, which will be an advisory element. And so, like, for us, this has actually been crossing my mind a lot lately, because if we acquire another accounting firm, just a small one, where they're just doing that tax component, we can offer those additional services and like for no other marketing, so to speak, have a client base there that they might actually go ahead and buy those additional services. And
absolutely, 100%. And Ben, that is so tried and tested. Absolutely tried and tested, and it just works. It just works beautifully. And when I say it works, I guess I have to be careful, because I am so passionate about it. I don't want you as a listener to think, oh, boom, like super easy. It's not, there are things, of course, there's things that you have to learn along the way. The more you do it, the better you get. You need transition. But if you have a solid base to start from, this is just like, this is a force multiplier. This is exponential growth. This is you're better at analogies than I am, clearly, Ben. But it's
oh dear,
it's like a drug for your business, but all legal, of course. Business value arbitrage. Now this is like big words, but the concept of this is that the larger your business gets, the higher this multiple is. And when we talked about, I guess the great example of business value arbitrage is really just this example I gave you before of my business owner who was exiting. Let's just see if he decides he's still so committed to that right at the moment, now that he's found a new passion for his business through acquisition. But the arbitrage of having a valuation multiple of 4 or 5 or whatever, and then adding a 1x multiple business, it suddenly getting thrown up in value to that 4 or 5 times multiple, but you might move from a multiple of 4 to 5 as well, because you're bigger, So this is that arbitrage, which is just, wow, right?
Yeah. Yep.
You can see why I'm excited with it.
Mm-hmm.
And then just like some other stuff that are opportunities, access new markets, reduce, you can buy up your supply chain. So, you can secure your supply chain by acquiring a business that's earlier in the supply chain for your business. You can reduce costs. You can bring on board technology staff. So when you're acquiring to bring on board certain staff, we actually call that an acqui-hire, an acquisition hire. So, and that's often the term given to a small business that we buy, but we're really buying them for the staff that are there. And expertise. And there are heaps more. I've got an ebook. I'll send this to you. This, or you can get a copy. I'll tell you at the end how to get it. I'm also in the middle of writing a book, and I go through this in a lot of detail. But anyway, there's heaps more reasons, but that's enough for now. So let's talk about, let's get detailed. What's the process? Yeah. Just sort of give you a little bit of an overview, so you get a bit of an idea of what the deal flow looks like. So you've got to go out. Yeah. Oh, can you see this? Sorry.
Yeah, I can. I'm just seeing a question pop up. So Yanni has asked, would you describe acquisitions as a synonym for investing in startup or early stage founders, where their company offers your business innovation synergy as well?
Yeah. That's one. That's certainly not the only reason. And there are lots of other, and we call that acquisition entrepreneurship. So we're bringing on board, but absolutely 100%. So, and that's, we're talking about acquisition for growth at the moment. Of course, there are other ways of looking at acquisition. Acquisition in order to start a business can be a really good way to start it. That's not the topic that we're talking about today, but that is also something to bear in mind, depending on how you're approaching acquisition. We've assumed you're acquiring for growth, but you might just be thinking, I hate my current business, I want to start something completely different. Well, I tell you, buying a business is a hell of a lot easier than doing a startup.
From scratch for sure.
Yeah, absolutely. But but I haven't got a slide on that because we're not really talking about that today. But it's definitely I think a far superior way to the traditional startup. And in fact, I had this discussion again, another discussion last week. We talked to a lot of people on a weekly basis who are buying and selling. And this business, this other business I spoke to last week, they're a technology startup, and they spent, I think he said, like 5 years in investing a heap of money, because technology startups can drain a lot of money. He'd spent a lot of time in building this really awesome product, ran out of money, has run out of energy. That sort of happens after 5 years when you're building something, and he's ready for market, but he's just run out of energy. And like, that's a brilliant possibility where there might be a synergy in that technology, or that software or whatever it is, bringing it into your organization and just helping to give a bit of new lifeblood. And, someone's looking to sell, they might only want to sell 50%, but that might be a great price because someone just needs a bit of funding for the 5 years that they've been in it, but be a bit of, new energy and enthusiasm. And here you have something to then take to your own market. You've got a ready market to sell it to. So,
and everyone wins in that situation, even the person with that energy.
Yeah, 100%, because that can reinvigorate them as well.
Yeah, cool.
So here's the process. So, and what I don't have here is you need your strategy first. Like, what are you trying to do? Let's get a strategy of how you're getting there. So that's the first thing. Then you need, so you can work out what your targets are. What do they look like? Where are you going to find them? So go find your targets, understand a bit about the business to the extent that you can agree on commercial terms. And when I say commercial terms, I mean, how are you going to buy it? price and timing of payment. Then you put this out all together in a term sheet, and term sheets can be called so many different things, which is, very exciting. You can call them term sheets, heads of agreement, memorandum of understanding, letter of intent, non-binding letter of intent. I could go on. There's so many names for them. I did a podcast one day on this because someone called me and said something. Oh no, not an MOU. I mean, no, I'm talking about, a commercial terms document. I'm like, okay, stop. The industry has got to stop. This is all the same thing. Anyway, so after all of this, it's just something to record our agreement.
Mm-hmm.
Then
you find the target. The commercial terms is like you have a conversation with them, discuss broadly.
Exactly. And then you come to some sort of initial short 2-page agreement. Cool. And in that, one of the things that you should be building in is making sure you have a period of exclusivity while you're kicking in funds to due diligence.
I see. Yep.
Because you don't want to be spending money on advisors if someone is just going to come and buy this business from under you. So we usually get term sheets in place, and they're usually called non-binding, but what we're actually trying to keep, what we keep binding, and which is important. Some people don't realize you need legal advice at this point because we need to make sure it's working right.
So my opinion is you probably need it as you find targets or before then. But
absolutely.
So where do we get that term sheet, or where do we bring you in, let's say?
Yeah. Well, sensibly, I think the right place is right in the beginning before you're starting, because actually the best place to start with all of this is making sure your current business is strong enough for you to withstand an acquisition. Yep. So I actually think that's the first, and that's not even in the flow here. Goodness gracious. I have to change this diagram too. What do you reckon?
Strategy.
Yeah. That's right. That's right.
Yeah, cool.
But right in the beginning, it is about, making sure you're super clear about what you're doing. And I think at that point, you need to get together your deal team, your accountant and your lawyer, to sit down and get clear on what your strategy is and how your business is looking from a strength perspective before you start it. So that's what I'd say right in the beginning. Where we get involved in the actual deal then comes, at least by the term sheet stage, so that we can help make sure you have a period of time of exclusivity.
And actually, just on that, Joseph's asked, is that period of exclusivity a bit like a property contract? So you've signed the contract, but still being conditional on even due diligence, right?
Yeah. Well, we can do it 2 ways, actually. So we can do it either in the term sheet, which is the exclusivity. The problem is that exclusivity will end at some point. So generally, we see exclusivity between 4 weeks, like 1 month to 3 months. That's a general exclusivity period. The problem is when you get to that period, you generally just on a term sheet, so a couple of page documents, something super short, you generally don't have enough to force you're not forcing the seller into the transaction because you haven't got enough in terms of the meat or the detail of how it's all working. So if you want to go through that process and you want to lock them in, which is also a really good idea, you need to go through the transaction documentation, which is the next step. So transaction documentation is the sale of business contract or the share sale contract. And it might also be employment or consulting agreements if you're keeping on board the seller for a period of time. It might be shareholders agreements. There might be a few things that are part of it, but let's just think of it as sort of just broadly the sale documents. You can enter into the sale documents quickly and then have a right to pull out on the basis of your due diligence findings or finance or any other terms. So we call those conditions precedent, but it's like a funky legal terminology for giving you the right to pull out. So in relation to the question there, you would actually need to exchange contracts first. And that can be a really good approach. Sometimes it's not. So that's when you need to, we need to sit down together and go, okay, what's the best way to protect you in this situation? Which way should we go?
Yeah, fantastic.
So due diligence can just happen right after term sheet and before transaction documentation, or it can happen while all of this is going on, it just depends on the deal itself. And then exchange is when we sign contracts and hand it between each other. Pre-completion is getting everything ready, so starting to transfer the assets.
Mm-hmm.
Completion is when that's it, you pay your money, you get the business.
Mm-hmm.
And then integration is when we are now integrating it with our current business. So that's sort of the way the flow goes here.
Cool.
And I call these the 5 drivers of killer deals. So this is what I think you need to be focusing on.
Awesome.
So number 1 is preparation. You need to get yourself sorted right from the beginning. And this is where I'm talking about, make sure your ship's in order. Right
your ship or your shit, sorry.
Actually, it's a really good point. It could work both ways. I did say the non-swear word, so you don't have to take this out.
There you go. I couldn't help myself. Oh dear.
I might change that too. I mean, it's more impactful, isn't it? Yeah. Make sure your stuff is in order. And make sure you understand where you're going. That's really important. Do you know what? That sounds so obvious, but in many instances, I find the greatest issues have occurred from just a lack of clarity of what the goal is and what success looks like at the end. So just get clear. What does success look like? And then we move on to finance. Have you got your finance in place? And do your staff know how to deal with integration and transition once it all happens? And then, of course, getting your deal team in place. So making sure you've got the right pieces of the puzzle, people who've walked the fire before and understand what you're going through. And also, I just want to add here, I think there's a massive benefit in having your deal team, so your accountants and your lawyers, and it might be your brokers or advisors or whatever, but particularly your lawyers and your accountants working on it together, being your integrated deal team. Because I find, I love the way you guys work, Ben, because you get that. But many accountants like to sit in their own silo, and just look at the accounting silo. And I just think the best result for our clients as a whole is when we're able, to be a bit more integrated and talk together as a deal team, because we're in this together and we're making this work together. All right. So then we talk about value. So preparation happens before you find your target. Primary value, these next steps really kick in once you're on the path and you've found your target or you've found your targets. Here you're looking at value. So what is the value in the business and how will that transfer to you? And sounds obvious, but in many cases, businesses who are acquiring don't actually think really clearly about this question. What is the primary value? How is it transferring? And the reason why this is so important is when we move to purchase structure, you'll realize there's lots of ways you can actually shape a deal. So, a deal can be shaped. It can be a business sale. It can be a share sale. It can be an asset sale. So that's a different type of ways of selling it. But it could also be money all up front, or it could be money that's deferred over time. So you're actually getting the vendor, the seller, to finance your acquisition. It could be deferred payments or earnouts sharing risks. So if you think there's risk, sorry, if you think there's risk in the value transferring, then you might say, okay, well, we're going to share this risk with the seller so that they're really invested in making sure this value properly transfers to us. So I am going to make the sale price partly deferred on the basis and contingent on the basis that certain milestones are met. So, it might be revenue milestones. It might be staff coming across. It might be certain clients staying on board. There's heaps of different possible elements of value that you might want to use purchase structure as a way of focusing on? I feel like you're going to say something. Go for it.
Yeah, or more of a question. So again, the lens I'm looking through is to purchase another accounting firm, or even like a small one. And I would see my risk as, the clients don't move across, or they're not sticky, that they might leave after 12 months.
Yep.
And so one way I can think of incentivizing the seller or the exiting, call it accountant, is to even have performance bonuses in there. So things like, okay, yep, here's the purchase price of the actual business, but if 100% of the clients stay, you get a 20% bonus in 2 years, or can you build those sort of things in?
100%, absolutely. And that's why it's so important to go through this process of thinking about that, like what is that value, and then going back to your purchase structure to make sure you're finding ways that will actually transfer. Because particularly, in accounting firms, if we're using that as an example, there's a couple of ways that we do that. So in accounting circles, quite often they'll use this terminology of retention. So retention of funds. So there might be an agreement on price, and then there might be this agreement to pay 80% up front, and then a retention of 20% on the basis of certain milestones being met. Actually, retention is just, wording for the accounting profession in business sale and acquisitions. The rest of us call it earnouts, but but it's the same thing. Yeah, exactly. I mean, terminology for different industries. It's back a bit like the MOU, letter of intent thing. Ultimately, this is where people get confused, because they get confused with the name of things, rather than what we're doing is we're coming back and we're saying exactly what you just said, Ben. How is it that we make sure that value transfers? Let's do it with incentivizing the seller. Okay, how are we going to do that? And then who cares whether you call it earnout, retention, whatever. Ultimately, we're building things in place to make sure both you and the seller are incentivized to make sure that happens, and so so primary value and purchase structure really in that way are very interlinked together, because you need to understand value first and how that's going to come across before you even consider what's the best structure for this acquisition, because there is share sale versus business sale as well. And sometimes a share sale might be a better way of retaining value, but it might have more risk. So, we're offsetting all of that together. And so how are we going for time? Am I taking too long?
We've got 15-ish minutes left.
Okay, all right. I'm going to whiz through the rest. Protection is where we say, where's the risk in the transaction and where's the risk in the business moving forward? And so that's really where we're digging into due diligence. And then we're using the contract in a smart way to protect you. And then the last element here that I haven't talked about is process. And this is something most lawyers won't even talk about, because most lawyers don't have a defined process for how they see acquisitions. Sorry, you were going to say something there.
I just said yikes if they don't have a process. Geez.
No, right, yeah. But and they might have a process in that, they know the contract goes first and then you negotiate it or whatever. But the way I see process is, how is it that, what are the things that can cause deals to fall over? And how do you protect against that from the beginning? And a lot of it is based on emotional intelligence, making sure the parties are communicating, making sure that you're not getting caught up in the quagmire of pointless detail, that you're actually focusing on the big picture and the important things. And also that you're dealing with someone that's got templates, checklists, and processes to move this forward. So they're the 5 drivers of killer deals. And just super, super quick, as I said before, important to fortify your business before you acquire and then after. And for this, we talk about identifying and protecting, and then preventing and predicting. So it's identifying issues that might be there, sitting there in your business. There could be landmines that might be about to go off. And we find growing businesses quite often have these vulnerabilities in their business because of growth, because they have a different infrastructure need now to when they started their business. And then it's about once you've identified these key risks, it's about protecting your business and protecting against these going off. It's putting in place prevention, because we say prevention is so much cheaper, easier, and more time effective than trying to battle the issues and find a cure afterwards. And then prediction systems, i.e., some systems that will alert us ahead of time whether there's issues that might be brewing in the background. So that's pretty much it. We've got an ebook if you'd like it. I guess the order of what to do now: get your ship in order,
get your ship together.
Yeah. CP, fortify your assets, get your deal team together, get the people on board, who can help guide you through the process. Get educated, understand what you're doing. We've got a really cheap, i.e. free book, the Business Acquisition Playbook. Just email us at acquire@aspectlegal.com.au to get a copy of that. And we've got a pilot program. I just thought I'd throw here really quickly. If anyone's interested, just email us at acquire@aspectlegal.com.au. But this Ready to Acquire gives you a legal health check for your business, access to Lawyer Line, which is calls to our legal hotline whenever you need it for a 12-month period. So you can have on the ground help when you need it. And then we've got the so that's strengthening your existing business. And then there's a getting acquisition ready or red. Anyway, it's meant to say ready. We've got an acquisition consultation. We've got templates, an NDA, a term sheet, and a DD checklist. And then we've also got an acquisition Facebook community coming. So this value is more than $6,000, but you can have it for only 169 plus GST per month. What do you know? That's pretty cheap, wouldn't you think?
It is. Sorry, we didn't actually run through this beforehand, but so you're saying that, let's say we're considering an acquisition, and we want to have the Lawyer Line, which is like phone a friend for legal questions here and there. Hey, here's where I'm at right now. Where do I go? What do I do? For $169 a month.
That's it. Exactly. And so for this, we don't prepare documents, and it's not once we're in the in the transaction, but this is like, I got a burning question. I need a lawyer to ask it. I've got an employment issue going on. I just need to speak to someone about a lawyer about it. So you're saying it's not just acquisition-y stuff. It's just any sort of general businessy stuff. Exactly. Yeah. Jeez. And do you know why I have this? I have this because my belief is that businesses get themselves into legal trouble because they don't reach out for advice early enough. And this is about prevention. I'm all about prevention because we don't want to be the ones to fix up the mess. We want to help you avoid it in the first place. So that's what this is all about. So if you can, just email us. We can send you more information.
Awesome. Thanks, Joanna. That's I think that's superb value. That's
brilliant. And don't forget, of course, about the podcasts, Deal Room and Talking Law. And then here's some more questions. But Ben, I don't want to eat into your time. Why don't you take over, and then we can come back to these if we feel like we haven't answered them all.
Yeah, absolutely. And just while I share my screen, Joseph's asked 169 plus GST per month for how many months, or is this ongoing like a retainer?
Yeah, it's a retainer. So you can stop. So we have a minimum period of 12 months and then continue for as long as you want.
Fantastic. All right. Thanks, Joseph, for the question. But yeah, encourage you, if you do have questions for either Joanna or I, please pop them in the chat box or the Q&A box, and we'll run through that. I don't have a ton to say, but I just think maybe from an accounting perspective, some key points I think are important to remember with acquisitions. And one of them is around business value. And one of the services we can help with is business valuation of a prospective purchase. And a couple of the ways that you might value a business is a multiple of profit, which we talked about before. Joanna, is that like what percentage of businesses you reckon would be done on that basis?
Yeah, most. Yeah.
Okay, like 90?
Yeah. Yeah, probably. Other than, so accounting practices are different, but
They're a bit special.
Yeah, that's right. That's right. But most other businesses will be, well, it depends actually. In the technology space, quite often it actually becomes less about even profit or revenue. It can become more about, like what's the value of this asset, because quite often there won't be and if we have a business that is making a loss or those sorts of things. Yeah. And then when we're in the acqui-hire, so we're acquiring a business for the talent, we might go back to revenue rather than profit as well. But generally, like I think 90% is a pretty good indicator of the profit multiple versus revenue.
Yep, that's pretty cool. And then that, so we talked about multiple of profit, we've got multiple of revenue, and then kind of whatever someone will pay, and that could
so
be
true.
I think a lot of it's got to do with what's it worth to your buyer, and it's important that maybe the one of the first two options might start the conversation, but who knows where it will go. If we are looking at profit, or this thing called EBITDA, which is an acronym. I've sort of spelled it out here, the acronym. So we've got earnings before, so earnings, aka profit, before interest, tax, depreciation, and amortization. So depreciation is that write-off of your assets, let's say cars or equipment that you own. Depreciation is claiming a portion of that each year. Interest is interest on any debt. Obviously, tax if it's a company. Companies pay tax. Trusts don't if you're acquiring from a trust. So that's the acronym we usually apply the business multiple to. Also, you need to remove owner's benefits. So often if it's a small business, the owner might be putting their car through, their mobile, which you don't need to pay for if you acquire it. Any other benefits to them need to be taken out of that or added back to the profit figure. Likewise, this third point here, it says you need to pay the owner. So if the owner's working full-time in the business, but let's say, a lot of our clients are structured as trusts, and usually we take the profit from the trust and distribute the profit. We don't pay a salary before the profit. So we need to go and adjust that profit figure to pay a market rate salary for the, what we need to go and hire someone to pay for that, to run that business. So you need to replace the current business owner. That could be a process in adjusting that profit figure. So anyway, that is kind of covered when if we were to help a client with looking at valuation for a prospective purchase or even their own business. That's some discussions we have. So cool. So that's a little bit about business value. In terms of due diligence, that's what I would strongly recommend is a combined process between accounting and legal. It's not either or. Got a little cool thing for our clients. I'm just changing screen shares. But we have a couple of checklists, which, when we send out a recording for a webinar, it's on an e-learning platform. If you're a client of Inspire, you'll automatically have access to this checklist. Unfortunately, if you're not, it isn't included, so to speak. But there is a pretty detailed due diligence checklist, and they're almost like questions just to ask and go through and cover off. So, starting with, why is this business for sale? Like, just because? Is the person dying? Is it, what's going on? What's the, what's the deal? And
can I just say that's such a good, I love that your checklist starts with that, because understanding the motivator of the seller is, like, I can't tell you how important that is in understanding whether the deal will actually go through in the end in the first place, but also understanding where your levers are, because ultimately when you're trying to drive a win-win. You need to start with understanding what they see as a win out of it, and why they're selling.
Yep, no, that's it. So, this covers things from sales to costs to profits to assets, all that sort of stuff. So, if you are a client, log into the recording when it gets sent through to you, and you'll have access to these downloadable checklists for due diligence. There is 2 of them as well. So, that is exciting. And the last one there, just sort of generally, there's kind of 2 main ways to, I think actually maybe 3 which I know we were talking about before we kicked off. But there's two main ways to purchase a business. The first one is to buy the actual business or assets of the business versus the shares in a company or the units in a unit trust. So they're kind of the two main. The business or assets, the accounting word for that is goodwill, is the most common way. And you buy the seller's business into your own entity in most cases, versus the shares or units where you actually, like that, let's say they run in a company structure, you just buy the shares off them, whether in part or in full, depending on the structure of the purchase. And there's pros and cons between both. So anyway, I won't go into the detail on that, but I've just made a couple of dot points there. So we've got 5 minutes left. Joanna, you've got a bit of Q&A pre-planned. There is a couple of questions in the Q&A box. And just before we wrap up into Q&A mode, I do want to offer as well, if you aren't yet working with us and you do want to have a chat about coming on board as a client of Inspire, feel free to do that by booking in a strategy call with one of our accounting team. Rose from our team is going to pop a link in the chat box if you do want to have a chat, whether it's about acquisitions, valuations, or just sort of general tax and accounting help. But feel free to, we'd love a chat if you're considering looking for an accountant. So why don't we?
Brilliant. Yeah. Well, let's tackle what's in the chat box first. So if you haven't had your question answered, why don't you throw it in the in the chat box, and we'll talk about that. And then if there's no other questions, I'll just shoot to the slide where we had some questions and just make sure we've covered it all. So we've got a question about funding the acquisition if there's not enough cash to cover the agreed price. Yeah, and that's very common. So I would say maybe a very large percentage of our deals will come through as having been funded. So you can fund, there's a number of ways that you can fund it. So you can fund it from your own investors into the business. So that's one way of doing it. And then you need to make sure that you have the right investor agreements, shareholder agreements, unit holder agreements, whatever the structure is, the owner agreements in place. So that's one way of doing it. Another way is taking finance against the business itself. Now, there's certain industries where and certain amounts of finance where you potentially can get 100% finance. Like, say, for example, medical practices, dental practices, veterinary practices, they're all examples of businesses where you can quite often get a full 100%. Accounting practices, legal practices, those sorts of businesses, the types of businesses where you can potentially get 100% funding from banks or financiers, traditional financiers, straight away. So, and then that can be, such a great thing. If you can get 100% funding, you're not putting cash in, and you've just got this, and then you've acquired something that gives you an immediate uplift. It's just like free money.
Yeah, basically snakes and ladders. And I just want to add to that one as well. We sometimes use a special type of trust where you mentioned in there, Yanni, that super fund assets. So if you've got a self-managed super fund, we do have a structure where, as long as you've got other investors, we can set up and use your super plus a bit of theirs in a special type of trust to then lend money to that business to purchase. Your own entity to purchase the business. So a bit of a complex one there. But if you did want a bit more information on that, just send me an email with the word SUIT in it. That's the acronym we use for that type of trust. So,
you guys are so creative, man. And of course, I guess the one thing I forgot to say is there is that sort of like super traditional way of going and getting finance connected to your own property or whatever. It really is far lesser used because there are lots of other options around it, and of course it creates potential restriction in what you can do with those assets, like for example, property.
Mm.
But anyway, that's certainly an option that some people use.
A little bit higher risk from an asset protection perspective.
100%. Yeah, exactly. Yeah. Yeah. We have to have serious conversations about that. Yeah. Okay. So it looks like there's just throw in there any other questions. Otherwise, I'm going to run through.
There's a couple actually.
Oh, there are. Have I missed them?
Yeah. That's all good. I'll fire them over. So Yanni's asked, is there a source where industry/business comparables could be accessed for valuation multiples?
Oh, that's a good question.
We've actually got a couple of different specialized industries that we can access, but it's not like a public source of info. We pay for sort of software and resources around that stuff. So it depends on the industry, we can give you some stuff around that. It's not like looking up RP data with house prices.
That's right.
Unfortunately,
exactly. There's not a general public database. The databases that exist are very expensive and are on subscription basis by your accountant, Ben.
That's it. Alrighty.
What else have I missed there?
So I'll suggest a couple of the points here, but Joseph's asked, beside legal costs, what other costs are there to acquire a business? So from my perspective, there would be accounting fees, not just legal, for help with due diligence. There's also potentially tax, depending on how you purchase it. So and depending on which state you purchase the business in. So for instance, in Queensland, if you were to buy a business/asset sale or purchase, then unfortunately you pay stamp duty on that, but New South Wales is zero stamp duty on that. That's correct? Yes,
that's right.
Yeah, a little bit more progressive down south than
I know. I can't believe you
that
guys
point anyway.
Still, isn't it?
What else would you add to that in terms of like transaction costs?
So I guess it depends what advisors you want to get on board. Sometimes it might be that you want to do a technology audit, or you need to do an HR audit or something. But all of that comes back to understanding, well, where's the value and how do we identify whether that value is there and transferable? So it's that value question. What is it that you need to dig into? Well, that sometimes can link into other costs. So we have clients who go in and these are clients that we do many multiples of acquisitions for, and some of them will have say a technology audit. Wherever they go in, they'll have someone who'll look at the equipment list and look at the valuation of that. There might be those sorts of costs, but other than that, legals, accounting, any costs related to due diligence or confirming the value, it's really that purchase price, and then considering the time cost, I guess, of your own time down that path, and then the integration of the business into your business. So I guess they're the main costs.
Yep, that's it. Cool. Quokka's great presentation. What's your advice if there's no term sheet developed, but there's been a lot of conversation and the contracts are in development? Is it worth clarifying the term sheet, or are we kind of already there with the contract?
It depends. It depends how close your contract is to being finalised, because if the contract has just come to you, then it may not be in a very final state. As in it may not be advantageous for you, and you may have to do some work to make sure it's reflecting the best deal for you. So I guess it just depends. But I think there's no point going back and creating a term sheet if you're almost at the end, you're almost exchanged. But there is if you're not exactly sure where you are in the process, and it would benefit from having some sort of protection to you. So the point of the term sheet is, number one, to clarify between the parties what the deal is, and number two, I guess give you some sort of protection in terms of that exclusivity period. So if you don't need either of those, then no, there's no point going back to the term sheet.
Cool. Great. All righty. And Howard, it looks like a comment rather than a question, but paying the owner is a subject business brokers either don't want to understand or deliberately pretend they don't understand.
Sorry, what was that? Paying
the owner is a subject brokers either don't want to understand or deliberately pretend they don't understand. Sounds like something interesting's happened there.
I
Howard,
know. I'd love to hear the story. I don't know. I don't know. Look, brokers can have a bit of a bad rap in the industry. There's clearly different types of brokers around, and different levels of experience and different levels of professionalism. I totally agree with that. I know loads and loads of business brokers who I know can be super helpful in a transaction. Do you know what? You need to understand what drives them. They don't get paid until the deal's done. So as long as you understand how it works, then you can use business brokers can be your best friend. Yep. You just need to understand the game. I think that's what I'd say to that.
Pretty cool. And then last one, we're a little bit over time, but John has asked, do you ever take a position on the board for any companies you undertake acquisitions for? So a formal board role, or is it more an advisor role?
Yeah, we're more an advisor role. Having said that, some of our lawyers are board members on even, sorry, that's my dog there. She's a bit noisy, isn't she? On even listed companies. So we have that expertise in-house, but usually it's more as an advisor role.
Yep. Yeah, no, cool. Joseph has asked, I'm looking at buying a book of clients, financial planning, financial advice. Is that a very different kind of acquisition from buying a business that might have bricks and mortar and staff with it? So yeah, book of clients versus premises, staff staying on board.
Every acquisition is different. Yes, that's a different type of acquisition to a bricks and mortar business, but it's also different. That bricks and mortar business is also a different type of acquisition to a technology business, there's lots of different nuances, and we still come back to these fundamentals. Where's the value? How do we make sure that value transfers? So yes and no, I guess.
And it might be different due diligence, or you don't have to do the 100%. HR stuff.
Oh, of course, that's right. So, and it impacts what you're taking on board, impacts where you're looking in the business, obviously. And once again, going back to, well, what's the value? How does it transfer? Where's the risk? Where's the transaction risk, and where's the ongoing business risk? And so those always have to be appropriate to what it is that you're buying, and will be different for a small business, a large business, a bricks and mortar business, just a book of assets, a technology business, you know what I mean? So I hope that probably doesn't fully answer it for you, but it gives you a bit of an idea.
Yeah, no, that's great. All righty. Well, I think we might wrap up there. Feel free to, I think Joanna mentioned it's the, is it acquire at?
Yeah, acquire at aspectlegal.com.au. And actually, it's a good idea. How about I put that in this, acquire at aspectlegal.com.au. Acquire at aspectlegal.com.au.
If you want a copy of that ebook, or thanks, Yanni, or the take her up on the offer of the
ready to acquire, strengthen your existing business and get acquisition ready.
That's it. No, that's so good. And even that lawyer line alone, I reckon, is worth that $170-ish a month. That's fantastic. Awesome. Well, always great to chat to you, Joanna, and thanks again. We'll actually be having a second webinar with Joanna in a month or two. We already got that booked in, but that'll be exciting to have you back again. But thanks again for giving up a Friday morning.
Oh, thank you for having me, guys. I hope it was somewhat interesting and I didn't overwhelm you with my enthusiasm for acquisitions.
Fantastic. All right. And thanks everyone for tuning in and the questions. It was pretty an engaging webinar, and we hope to see you on one of our future ones. Thank you. Cool. Thanks for that nudge, Rose.